The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very good morning and warm welcome to Squawk Box Europe. I'm Juliana Tadaba with Steve Cedric, and these are your headlines this morning. Nvidia shares fall after hours as the AI giant projects slowing revenue growth and misses expectations in its data center business.
The German defense giant Rheinmettal opens what will become Europe's largest munitions plant. The CEO Armin Papperger tells CNBC there is more to do to increase defense production.
We do our utmost. We do whatever we can do, yes, to be forced. And I had a chat before with Minister Pistorius about that. He said, hurry up, we have to do more, we have to do more.
And the recovery, no, it's not recovery, I'm afraid. Tesla's European sales slump again in July, down over 40%, even as demand for electric vehicles across the continent rise. That is a 7th straight month of falling market share for Elon Musk-led company. Yes, I've done 2 this morning.
You going to let the viewers in on what
I'll
you're
let
talking
the viewers know, because I believe you can overload on social media by putting too many out in one go, and you lose all the followers. So I couldn't resist this morning because there's so many great stories. So I did one on Nvidia debrief, because we're going to speak to Arjun in 2 seconds' time about that, which is a huge story. And I did one on Tesla versus BYD in Europe, because the numbers are enormous.
Well, I'm glad you took my advice of timing it a little bit better, waiting perhaps until a few more viewers are awake.
I'm not very good at social media, as you well know. Anyway, so the top story.
Top story this morning, Nvidia. And I guess we should get right to it. We do have Arjun standing by to walk us through the detail, but let me summarize for you what we heard. Nvidia shares falling in extended trade, wiping more than $100 billion from the firm's valuation as investors used to blow out earnings beats, digested a report largely in line with estimates. The world's largest, most valuable company sees sales coming in at $54 billion next quarter, slightly above most estimates, but below the $60 billion predicted by some analysts at the top end. Now, data center revenue, which accounts for almost 90% of the company's business, disappointed, despite coming in at more than $41 billion in that segment's second consecutive miss. But perhaps unsurprisingly, CEO Jensen Huang was bullish on the earnings call.
The age of physical AI has arrived, unlocking entirely new industries in robotics, industrial automation. Every industrial company will need to build 2 factories, one to build the machines and another to build their robotic AI. This quarter, Nvidia reached record revenues and an extraordinary milestone in our journey. The opportunity ahead is immense. A new industrial revolution has started. The AI race is on.
Okay, Arj, yesterday you previewed the numbers for us. You told us that one of the most contentious parts of the results was going to be the China story. So tell us, what did Nvidia say about what's happening in China, and what specifically about the guidance has disappointed some investors?
So I think overall, very strong report, but it was the China story that really muddied the waters here for the overall report. And that's because Nvidia gave guidance for the current quarter we're in at about $54 billion of revenue, but they assumed that meant no sales of the H20 chip to China. Now, going into this report, what we heard was Nvidia was going to get licenses to export the H20, that's the China-specific chip, out to China. And as a result, the US government would take a 15% revenue cut of those sales. What we heard on the call from the CFO was that actually there hasn't been any kind of legislation yet around that 15%, and there are still geopolitical issues that are stopping some of those shipments to China. And the CFO saying that there could be $2 to $5 billion worth of sales to China possible in this current quarter if the geopolitical environment permits. So that's where we're at with the China issue, and I think the guidance was sort of above expectations, but below that whisper number. I think that the market was looking for around $55 billion of revenue. It was only a slight miss, but really that was because of China.
But does it mean that the company doesn't expect to sell in China this quarter? Maybe this is a silly question, or they simply can't project specifically enough to factor it into their guidance?
I think they don't know. I think that's what sort of came up in this, was the uncertainty around the China equation right now is so high. They've been told, obviously, that they will get these licenses. President Trump has signaled that Nvidia will be able to sell again in China. The condition was this 15% revenue cut. But in terms of progress on that, it seems that there hasn't been anything made in terms of their ability to be able to ship these chips to China. And that's really, I think, what's holding back guidance. We know there was a lot of lost revenue. I think, Nvidia signaled in the last quarterly earnings that there was around $8 billion worth of lost sales potentially to China. But they are suggesting that if they were to sell in this current quarter we're in, that there could be $2 to $5 billion worth of sales. And Jensen Huang saying that he still believes this is a $50 billion market, and that actually China could grow 50% year on year if Nvidia were allowed back in. So that's really, I think, what was the black cloud over these broader earnings, which on the whole were very, very strong. And I think if you look at the core, that remained very strong.
By the way, your preview coverage was perfect. You nailed it all, so thank you very much indeed for that. A couple of issues. Let's go through the first one very quickly. You mentioned it briefly there. The US is yet to codify anything regarding this revenue share as well. And I've had my skepticism about the revenue share part of it for a long time. If that's the deal, then that's the deal. And my skepticism is ill-placed as well. But is anyone why would one investor be surprised that a deal struck verbally with the administration has yet to be codified as well? So why would anyone sell on the back of that as well, or bought it in advance of that? Because quite frankly, we just don't know yet on how that's going to work.
Yeah, absolutely. I don't think it's surprising that it's sort of not been legislated on. It's not been codified into law yet. And I think going into this, the China uncertainty was still high. There was was too much overexcitement when a few weeks ago.
It'll be an agreement codified by lawyers about a transaction.
Absolutely, yeah. And I think the market perhaps got a bit overexcited because there was so much negativity towards China when Nvidia said, we're going to be allowed to sell again, without actually realizing this is just this is a process that needs to happen.
Yeah. Okay, that's the first point. Second point, the option traders were wrong.
Yep.
It didn't move much. We said this time yesterday, we were talking about straddles and strangles and long premium strategies. Some of you will understand some of that. They said it was going to move 6% plus. It moved 3.1%, albeit that's the net move. Obviously, if it moved in today, you might have made money out of the trading. But so it's a very mild reaction to the numbers as well.
Yeah, I think mild.
Yep.
And I think that's because the market's looking at this at the moment and saying, well, look, if this China issue is resolved, they've got reassurances that they're going to be allowed to ship chips to China. We still know there is demand for the H20 in China, and that's very key. But I do want to just bring one other interesting point. Aside from that, you almost have to split this into what's happening in China and the core of what Nvidia does.
The hyperscalers are doubling their spending.
That the hyperscalers are doubling. That there's 3 to 4.
Is that what you meant?
Partly, yeah. Well, there's 3 to 4 trillion, according to Nvidia, of AI capex spending happening over the next decade, and that when you look at the core data center business, they were talking about while the sort of compute part, which is the GPUs, were sort of slightly down year on year. That was mainly because of China. Those networking parts of the business were doing well. But there was a really interesting line in there from Jensen Huang, who was asked on the call whether the 50% growth figure that is happening in China is applicable to the broader data center business. While he didn't commit on the exact figure, he gave some pretty bullish comments. Let's just listen to those.
The buzz is everything sold out. H100 sold out. H200s are sold out. Large CSPs are coming out renting capacity from other CSPs. And so the AI native startups are really scrambling to get capacity so that they could train their reasoning models. And so the demand is really, really high. But the long-term outlook between where we are today, CapEx has doubled in 2 years. It is now running about $600 billion a year just in the large hyperscalers. For us to grow into that $600 billion a year, representing a significant part of that CapEx, isn't unreasonable.
The analysts love it, but One thing I noticed, I listen to a lot of stories when I'm driving in, and juxtaposed next to the Nvidia story I was listening to the FT amongst others this morning on the driving in, was the Chinese chip makers are seeking to triple the country's total output of AI processors next year as Beijing races to the US to develop the most advanced AI. It's a great piece. It's by Jijing Wu in Hong Kong for the FT. Great piece. Good journalism where I see it. How much is Nvidia looking over its shoulder?
It's looking, but the competition is very far in the rearview mirror, I'd say. We saw, for example, just to give a bit of context, yesterday, a company called Cambricon.
I'm hearing a lot about Cambricon at the moment. Never heard of it before this week.
Yeah, so these are one of the sort of big AI players in China that are hoping to provide some sort of rival chips to the market. They're doing everything from the training chips to inference and trying to build the software around that. Now, they saw a huge 4,000% revenue growth in the first half of the year. They swung to profit, but comparative to Nvidia, I mean, very small numbers we're still playing with. But I think it underscores how a lot of the domestic tech players are looking to domestic alternatives. And so you can expect that some of the domestic alternatives will see some strong growth in the coming months.
Would you like to stay for the next story?
Why not?
Okay.
I like that response. He doesn't even know what the next story
I don't know.
is.
Well, he can read the prompt, can't he?
I don't
I know this company.
You know this company. It's called Tesla. And sales took another hit in the month of July, according to new data from the ACEA, which is the acronym for pretty much the European Automobile Association, which showed EU registrations for Tesla, drumroll please, down more than 40% on the year. Now, it's the latest in a traffic jam of declines. Oh, right. Is that the plural of it? A traffic jam of declines, or collective, for the car company, which lagged BYD in terms of market share. Look at the BYD number on your left of your screen, by the way, up 206%. They're not just wiping the floor with Tesla, they are wiping the floor with everyone. The Chinese firm surged more than 200%. Producer Jordan loves this number. It's a damning number. Jaguar, well, I mean, we thought it was a typo from the ACEA. And if you're just listening now to, I don't know, to the Squawk Box Express podcast, whatever it's called these days, you might want me to tell you what happened. EU Jaguar registrations a year ago were 376. Well, apparently in July this time round, they were 1. I thought they might have, I'm still waiting for the correction from the ACEA. Jaguar, disastrous rebrand, not got the right positioning at the moment. One's car sale. Anyway, what do you think?
Even if it's a disastrous rebrand, it is hard to imagine just one car sold across all of the EU. So I don't want to call the ACA out for any data issues, but it is hard to believe one car.
It would appear to be the case, though.
So,
Did you want to go? I remember you. How long ago was it? I had you standing at some, I think it might have been Shanghai Motor Show or something, and you're talking about all these amazing Chinese cars that were going to hit the world. How long ago was that?
Yeah, that must have been, 6 odd years ago?
God.
Something like that.
Wow.
Yeah.
Tell us, I mean, the evolution has been swifter than even you thought, perhaps.
Yeah, I think so. I mean, when I was in China reporting from some of those motor shows, the Chinese EV players were coming out with some very nice looking cars, and from the very beginning, we're talking about the technology in the cars, some of the automated driving systems, etc. And what they were able to do is bring these cars to market incredibly quickly, innovate extremely quickly. And what's taken me, I think, by surprise is the speed at which they've managed to expand beyond China. That was always going to be the challenge from a couple of perspectives. One, logistically, but two, also from a branding perspective. Will people in Europe want to buy Chinese cars? And I think BYD has shown that there is a market here for those cars, because they come out with them quickly. The pricing is very, very, very competitive, and they continue to focus on the tech specs. And BYD is the biggest probably of the Chinese EV brands out here in Europe, but there continues to be desire from XPeng, from NIO, and some of these other sort of more startup kind of players to export their cars here. And these are the companies that are iterating very quickly, and you see them launching cars every few months. And it's something that Tesla has struggled with, is they've relied on a stock portion of models that they've released over the last few years, but nothing new.
Yeah.
Nothing new.
Well, on that point, and linking this to something you brought up earlier this week, that when you look across cars these days, it's pretty hard to identify what brand they are, because they're all starting to look the same, especially when it comes to EVs. And it got me thinking about the smartphone market. And I think there's a number of analysts out there who think that the auto industry is going to move in the same direction that the smartphone market has gone in, whereby there's basically two operating systems, iOS and Android, and everyone in the world is pretty much happy to use a couple of those, and also obviously more in Asia. But it doesn't really matter what the phone looks like. It's all about the software and the operating system. To what extent is that becoming the consensus view here, that buyers are much more focused on the software, and in turn, the actual manufacturing is going to be less important when it comes to consumer decision making?
Yeah, I think it depends on the market. Certainly in China, there was a big focus on the tech in the car, the software, what can I do with it? And I think when you look at the smartphone market, you've got two dominant players, iOS and Android. When you look at the car market right now, it's still extremely fragmented, and you've got individual manufacturers hoping to lock customers into their respective ecosystems. I think probably one of the best examples of that is Tesla, of course, in what it's doing with autopilot and saying we're going to do over the air software updates and trying to lock people into this Tesla ecosystem. Xiaomi in China is another incredible example of that. This is a company that has built smartphones and rice cookers and everything in between, but also now cars running on a Xiaomi operating system. And so that's kind of the direction of travel here. Compared to the smartphone market, if you think about now, iPhones and Samsung and whatever else, you can pretty much buy a phone, trade it in the next year for a large still portion of that value. And that's probably something similar we'll see in the car market as well. You see it with some of these models.
Adam's given me permission to say one more thing. You heard him say move on, yeah? Okay.
I was going to say, is my earpiece working? That's not what I heard.
No. You thought he said move on. What he said was, Steve, you've got one more comment. EV depreciation rates have increased significantly, with some data showing a typical EV, I mean, this is the big number day, losing over half its value in the first 2 years. I don't wish, I want all the car companies to do well, let's say all of you, but my goodness me, which one of you out there is so rich you don't care about losing over half the value of your EV in the first 2 years as well? Buying a brand new EV, I know a lot of people rent them, I know they're on the deals, but actually physically buying an EV, which you know is going to lose over half its value in the first 2 years, all I can say is you're richer than me.
I was going to say, I mean, so far the EV market has been dominated by Tesla until recently, and we obviously know that Tesla has had its own very idiosyncratic drivers here, and we know Tesla drivers have been racing to trade in those cars, and there's less demand for Teslas in the secondhand market as well. So I wonder to what extent those figures around depreciation have been impacted by the weak demand for Teslas.
Do you want to get the last word in?
No. Oh. I'm going to let
music to Adam's ears. Cheers, Ash. See you a little bit later on.
I'm just trying to help Adam out.
Glad you stuck around. Coming up on the show, as U.S. tariffs on India double to 50%, we'll look at the potential economic and geopolitical fallout up next. Plus, Rheinmettal opens a new ammunition factory amid Europe's push to step up its defense capabilities. We're live from Germany, and we'll be joined by Nobel laureate Lars Peter Hansen, live from the Lindau Economic Forum. That conversation later this hour. Welcome back to the program. Let's get you a check on U.S. markets and how things fared yesterday, how investors fared. Major indices moved higher over the course of the day, fairly modest in terms of the magnitude of the gains. The Dow Jones adding about 145 points or so, the Nasdaq rallying 0.2%, and the S&P 500 rose 0.24%. 8 out of 11 sectors were positive in the session, led by energy, which gained about 1.1%. In terms of the trade overnight, here's the picture. We are looking at a mixed session. You've got the Hang Seng down about 0.9%, but modest gains elsewhere. Hong Kong, Nikkei 225, in Japan up about 0.7%, and the Shanghai Composite inching higher by nearly 20 basis points. Let's take a look at European futures. Now, over the course of the week, the the Stoxx 600 is down more than 1% after the heavy selling in the French market at the beginning of the week. So we're on pace right now to break a 3-week win streak, depending how the next two sessions go. This morning, we are looking at modest gains for the UK, French, German markets, but the Italian market looking to lose further ground, down about 0.2% at the moment. Looking at U.S. futures, here's the indication for Wall Street at this early hour. Not a huge amount of movement. We are, of course, going to be tracking Nvidia shares. To Steve's point, yes, the stock is down about 3% in extended trade, but fairly muted when it comes to the move there, given the expectation was for a swing of closer to 6% in either direction. So fairly muted reaction to those Nvidia numbers when you put it all into perspective. Now, on the trade front, Washington has hit India with a 25% additional tariff over purchases of Russian crude, doubling the total levy faced by New Delhi to 50%. That's the highest rate in Asia. The 50% rate has been likened to a trade embargo by Nomura, with textiles and jewelry set to be amongst the most impacted sectors. Speaking after the increased tariff came into effect, White House Trade Advisor Peter Navarro slammed India's purchases of Russian oil, referring to the conflict in Ukraine as Modi's war. Michael Langham joins us now, EM economist at Aberdeen. Michael, very good morning to you. Thank you for being with us this morning. This may be a difficult question for anyone to answer, but I'm going to put it to you nevertheless. The relationship between Modi and Trump has deteriorated so dramatically and rapidly since Trump came to power. We had been talking about India being one of the most favorable trading partners for the U.S., given all the rhetoric, the positive rhetoric that was coming out of the White House. What do you think changed that has led to this major deterioration in relations between the U.S. and India?
Well, I think from the India side, it's the mixed messages they're getting from the US. One, on China, Trump's taken a bit more of a friendlier approach than many had been expecting on China. India was expecting the US to work with it on counteracting China's influence in the region. So that's a mixed message. Then on Pakistan, I think that was a big slight from the India's point of view. Trump showing a friendly stance to Pakistan just after the two have been in conflict. And then on trade more broadly, I think in Trump's first term, we had seen him point to India as having high tariffs, but the aggressiveness in which Trump's approached this has caught New Delhi by surprise. I think from Trump's perspective, this is just part of his wider focus on rearranging global trade in this America First policy, reshoring parts of manufacturing, and seeing from his perspective, India's tariff policies is, unfair and uncooperative to US companies. I think that's a wrong take, in my opinion, but that's where we've got to. And essentially, on the trade negotiations, sticking points such as agricultural access are just something that Modi can't concede on. So that's where we've got to. These two strongmen leaders butting heads, and relations are at their worst in a long time.
In terms of President Trump's endgame, taking into consideration everything that you just laid out, is this the latest sanctions here, the latest tariffs, is it about Russia and ultimately pressuring Russia, or is it about India and what Trump sees as trade imbalances here? It's hard to understand what Trump is trying to achieve with India, and to your point, what Modi can offer Trump to try to ease the burden of these tariffs and perhaps get them lifted.
Yeah, I think that's the mixed messages angle that we're seeing. India does import a lot of oil from Russia, but China imports more. And so for India to be singled out with this 25% additional tariff, it does feel as though this is tied to wider trade negotiations, and that failure to get a deal over the line. Maybe Modi didn't go with enough of a begging bowl when he went to Washington and really concede to Trump's demands. And I think that's why we've seen India singled out on this front. I mean, for India, the cost of shifting away from Russian oil, it's quite small. Okay, it would hurt some of the refiners, yes, but we're talking about 0.2% of GDP. The cost of these tariffs that have been introduced, at least in the near term, are going to be greater than that. So there's certainly a way for a face-saving compromise to be found around this. India does comply with sanctions on Russian oil around ships related to that trade. So if the US were to expand its sanctions on ships, India would comply with that, and that's one way you could see India reduce its purchases of Russian oil without having to concede in an embarrassing way from their point of view.
Michael, I think we're conflagrating two issues here. One is your point about rearranging the global trade issue, which I've no doubt you're absolutely right about. But the other, the Indians have been naive and perhaps complacent about this. Let's be brutally honest about this. What the president is doing is trying to, whether we agree with the process or not, the president is trying to end the Russo-Ukraine war. And by putting pressure on the Russian economy, that is one way of squeezing Putin and bringing him to the diplomatic table. You say it's only 0.2 of 1% of that of the Indian economy, that oil that's coming in from Russia as well. But it is a massive source of revenue for the Kremlin, for the Putin regime. The warnings have been there for Modi's government and for India for a very long time. And quite frankly, you know as well as I do that the president is under enormous pressure from Congress to go way, way, way further than 50% tariffs. The Graham Blumenthal law would actually put 500% tariffs on countries buying that product as well. So I hear what you're saying about global trade. Difficult to disagree with you on that. But in terms of buying Russian oil, the Indians have had plenty of time to find alternative sources.
Yeah, I think it goes back to what was agreed with the Biden administration before. I think part of the issue is that India was encouraged to purchase Russian oil at a discount to put pressure on Russian revenues, but to maintain Russian supply to the global markets, as not to create an oil price shock around global markets. India's done that. Its purchases of Russian oil before the war was around 2% of its total purchases. It's now over a third. But now, obviously, the Trump administration's taken a different approach. But even on the Ukraine-Russian war, the messages we've got from Trump have been mixed. His approach to Putin at one point looked like he was going to take Putin's stance on things, put more pressure on Ukraine. That's now shifted in recent weeks. So from New Delhi's point of view, there have been some mixed messages around that. I do see your point that it's naive to assume that this wouldn't become a pressure point. But India's always retained geopolitical independence, and that's quite a key part of its national identity, is its ability to align with who it wants.
Well, I think we could argue about Indian geopolitical independence as well, especially when we look at the Himalayas, but we could argue about that on another occasion. Look, there is no doubt about it. I hear what you're saying. Some form of political independence is what you're saying. But there is no moral ambiguity about this whatsoever. Russia invaded a sovereign country, no matter why people think they did it. They invaded a sovereign country. And if India wanted to help bring about the end to that war in a timely fashion, it could actually do the right thing and stop buying this Russian product. That's not naive of me. I understand real economics and I understand real politics as well. But if India wanted to play a global role, it could actually encourage its refiners and everyone else to buy alternative sources. And quite frankly, the Indians are getting their oil anyway at cheaper levels than they've been over the last few years anyway. We're talking about $60 a barrel for the spot price, way down from the highs we've seen in the last few years.
No, I think it's a different perspective from India's stance. It's India first, as I'd like to think it from Modi's point of view. And yeah, I agree that if the aim is to bring about an end to this war, then putting pressure on Russian oil revenues is certainly that. I think, though, the US and the EU can do much more in terms of sanctioning more of Russian oil supplies and themselves from an EU perspective as well, reducing gas purchases. And that's where India sees the West hypocrisy, as they term it, on that issue. But I agree with you that India hasn't taken a harsh stance with Moscow on this, but then neither has Beijing, and we're not seeing Beijing facing this additional 25% tariff. It's just that India doesn't have the leverage that Beijing has, and it's now been left in an awkward position. Like I said, there's a face-saving route to this in which the US expands its sanctions on ships transporting Russian oil, and India complies with that. It has been complying with widening sanctions.
Michael?
That's a way that you see India reduce its purchases of Russian oil.
I hear you. And do you know what? Thank you, because I love the debate and I love the points you're making as well. And you are 100% right, by the way. The hypocrisy in Western Europe about Russian energy purchases is quite astounding. And our viewers will be gobsmacked by the enormous amount of Russian LNG that we're still buying here in Europe as well. Michael, your point is well made. We love speaking to you. Thank you, sir. Michael Langham, who is EM economist at Aberdeen.